Hey everybody, my name is Chris Chudikoff. Welcome to my show. I call it a podcast. I call it a quasi-interview. I have some exceptional people in my life that I have met that are incredible experts in their field. They're not good at what they do. They're great at what they do. I'm not looking for you to meet someone to make a referral. I'm looking to make an introduction. And today I have the pleasure of meeting with maybe the smartest homeowners insurance agent in the country that represents homeowners associations. It's very specific. It's very unique. And he's also a really great friend of mine. So let me tell you a quick story. So Cory, welcome. And I'm excited to talk a little bit today.
Thank you for having me. This is exciting. So let's get to it.
Yeah, let's just jump right into it. I mean, let's just uncover the white elephant in the room. How on earth do you continue to root for the Raiders after all these years?
Well, we got a new coach. We got Pete Carroll. So we'll see. You know, once a fan, always a fan. So we'll move on because I know we are in different camps. You're in the Tennessee Titans camps, and I'm here. So we'll just agree to disagree on that one. So
well, something we have in common is our teams suck.
Yes.
And every year we have this great optimism, like something's going to change this year. And the only thing that changes is the players, but the outcome seems to be the same.
Yeah, it's a losing record for sure. And I have season tickets to the Raiders, so it's even worse when you go see them in person and watch them.
Yeah.
So yeah.
Where did it come from? Where did the original love of being a Raider fan come from?
So some of my good friends that I've been friends with for years, my best man and another one, they were big Raiders fans, and we started making a journey every year to a different stadium to watch a Raiders game.
Okay.
That started almost 20 years ago.
Yeah.
And when the opportunity came for them to go to Vegas, we got to do this.
That was easy.
Yeah. So the three of us go, we make our pilgrimage, we do different things, we share it with friends, and it's good. I mean, it's just so electric there.
Yeah.
And you're watching,
different experience.
A football game. Yeah, for sure. So
I love that. But, Cory's a husband. He's a dad of two. He is one of the best networking individuals I've ever met. Like, Cory's a guy that's like, I got a guy, like no matter where he is. And that is something that I really appreciate about him.
And it takes one to know one.
Well, thank you. I appreciate that. But remember, this is about you, not me. So thank you. Let's jump right into one other really important topic. Are you a girl dad? Are you a dad of a son who just wants him to be rough and tumble? How's that balance work out?
You know, it's interesting. Just a little backstory, right? I come from two boys. So we had our first son, and I'm like, we're going to have another boy. Just how it goes. This is how it's, how it's all planned out.
Yeah.
And then my daughter Ava arrives, and I'm like, what do I do with this?
Yeah.
Right. And totally really what it's turned into is I get the best of both worlds.
Yeah.
I go wrestle with my son, play trucks, and then I'm getting tea time and Barbie dolls and all this other stuff.
I love that.
So it's been a growth for me.
Yeah.
To really expand and really pull out the softer side of myself, which is amazing. And you just see things in a different way. A boy sees, certain things, and the optimism of a young girl is totally different. And watching her doing plays and memorizing lines and what she finds passionate is exciting, right? Like we lose that in our day-to-day life, right? We're like, appointments, this, that, da-da-da-da. And when you see kids and you watch them of just the joy that they have, like you got to slow down and just be part of that. I know you do that with your grandchildren, and it's the same thing. There's life there that we need to really focus on because they have the answers. We've lost it, right? We've said no way too many times. They're still in the realm of yes.
Yeah. So. I really appreciate you saying that because it really solidifies, I try and say this carefully, it really solidifies my relationship with you because, I want to spend time with people that have similar views. I have a lot of friends, we have different views, whether it's political, faith-based, whatever that is. I appreciate because you and I sometimes have traded emails at 9:30 at night or a text, but I also know that you're not texting and replying to emails between, call it 5 and 7:30 or 8 o'clock. I know you spend time with your kids. So it's one of the things I can just affirm to you as a dad of 3 adult children now, taking our foot off the gas at appropriate times. It just gives them so much more. And I love that about you. And I know somewhere along the lines, your wife has to get some of your time as well. And I know that's always a delicate balance. I want I want to really dive in now with what you do for a living, especially given the current state. So Cory's the owner of a Next Tier Insurance, and he is a true specialist for homeowners associations. It's really his core competency. It's his focus. He knows it better than anyone else I've ever met in the business. He has a deep understanding of like what can be done and what can't be done. And given California's current insurance landscape, as we're filming this in February 2025, unfortunately, the timing of this is really great. So give me kind of 2 or 3 minutes on the challenge that homeowners associations are facing mostly right now. And then I'm going to have a couple segues to that. So kind of jump into that a little bit so the 3.2 listeners can actually have a grasp on really, because we all hear in the media, insurance carriers are leaving, and whether that's residential or commercial or homeowners associations. But I don't think most people understand the impact and how that's going to affect associations coming up even more. So give us a couple minutes, dive into that a little bit. What's the current problem? Mm-hmm. And then how do you solve for it? So
that's a great question. And yes, we just have to rewind just a little bit. So we rewind back to 2018 with the fires up north.
Sure.
There was a large
Paradise Fire.
Yeah, tons of loss, 12,000 structures. So that started this whole crisis.
Okay, got it.
So before that, insurance markets were relatively level. Admitted carriers, which those are the farmers, the state farms, they insured a majority.
Real quick, I want to interrupt for a second because we hear this term a lot. Mm-hmm. There's admitted carriers and there's non-admitted carriers. Yeah. If I understand it right, an admitted carrier basically kind of follows the state's guidelines and kind of gets a backstop protection layer from the state, or no? What's the quick difference between admitted and non-admitted?
Really, admitted is if you're lower risk, if you're a good risk to the insurance company, that's probably the best way to explain it.
Okay.
I like to use it like a credit score. And I know from a loan perspective, if you have a great credit score, 750, you get a loan all day long.
Sure.
If you have a 500 credit score, you got to go somewhere else.
Okay, got it.
So think of admitted as a high credit score and non-admitted as a low credit score.
The vanilla. If you fit the box and you're
exactly
a good homeowner,
and what makes you have a bad credit score? Loss history, right? You have a lot of claims.
Sure.
You have a lot of, you're in a high fire risk area.
Sure.
You have other attributes that don't make you as attractive to the insurance company.
Got it.
So that's the simple way. We can go into the technical terms.
No, that was great.
But I think from that, so those fires started this whole situation. HOAs were originally designed in the 70s, right? Relatively low cost. Insurance was cheap. Insure everything. Makes total sense. Yeah. Walls in, everything, which means the entire property.
Yeah.
Now that rates have gone up, it's like, wait, is the HOA going to be responsible for everything? And that's gone up dramatically over the last 3 to 5 years. They have admitted carriers, those farmers, those state farms, they are regulated by the Department of Insurance, and it limits how much they can increase their insurance rates each year.
Sure.
During COVID, they put a hold on it. So they had for 2 years.
They put a hold on the limit.
The limit of increasing.
Okay.
So everything went up in price, but these carriers weren't allowed to raise their rates.
They were kind of controlled, like you could only raise X.
Yes.
Even if the cost of labor and materials may have gone deeper.
Exactly. Okay, so, and on top of it, the regulations got even further where they say you can't cancel them. So think of a business that it cost you X and you want to sell it for Y, but now there's a government agency that's pushing it down saying you can't charge that much.
Yeah.
So what they've done, and what you've seen Farmer, State Farm, they started canceling policies.
Right.
They say we cannot remain profitable for what we collect, what we have to pay out, and what we have to keep in reserves.
Sure.
We can't remain profitable with these policies.
Yeah.
The big issue that happened with State Farm got a lot of negative press, and it's really not their fault that they canceled a lot of policies in that Pacific Palisades just last year.
Yeah.
And really what happened was they said it was a high fire risk and that the brush abatement wasn't being done properly. So they let them know what the risk was and saying, we can't do that.
Yeah.
So there is a thing called the California Fair Plan, which is supposed to be the backstop for all this. But that's being tested now because it doesn't have enough money.
It's being tested. I'm right after the Palisades fire.
18% of the Pacific Palisades houses have a fair plan.
Okay, so hold on. Let me, you know me, I swing in 9 different directions. Let's talk about that for just a minute, because 32 years in the mortgage business, I understand insurance more than most, but nowhere near at your level. So let's talk about that for a second, because there's probably some speculation around that we're all wondering. Let's just say the fund has $1 in it and the claims are $10, right? Which it's much more than that. How is the state going to deal with that? we can all think of, oh, they're going to raise taxes, they're going to print money, they're going to have a bond, they're going to do something. But what is your opinion, right, until we have facts about how are they going to solve for that shortfall in the California state plan? And then I want to get back to that other point.
Yep. So really what would transpire in the way that California Fair Plan is the admitted carriers backstop that. The easiest way I like to give analogies because insurance is not very logical a lot of times. Think of Social Security, right? We all pay into Social Security. And when you get there, you expect to have the money.
Right.
Right? Now, if there's no money in there, you're out of luck.
Right.
So what the Fair Plan does is the admitted carriers, as part of collecting their premiums, they pay in a portion of that to build up that fund.
Okay.
And that fund should be used for that. If that runs out, those admitted carriers, based off of how much they insure the state, will fit the bill for that. So State Farm has 25%. If they're short $100 million,
State Farm's going to pony the 25% of that money.
and the other carriers are going to do this. That's why State Farm just a couple of days ago said, hey, we need to do mandatory increases to be able to start collecting enough. And they also have the option to go further and go back to the insureds.
Yeah.
Just like federal government, right? Oh, the federal government's going to pay for it. Who's the federal government?
Yeah, we are.
So the insurance company is getting their revenue from where? Their insureds. So if they run out of money, where are they going to go to get more money?
Right.
Either higher rates.
High rates,
right?
you and I, homeowners.
And what do we know what's going to happen with what's going on with the recovery here?
Yeah.
The thing, I heard a stat that somewhere at the Malibu fires, which were really horrendous, right?
Sure.
A lot of destruction. About $4 billion in losses.
Yeah.
They're speculating over $250 billion.
Wow.
So the magnitude of this is so much more.
Yeah.
And I really try to, we've seen this before.
Yeah.
And unfortunately, we're repeating history, right? The Northern California.
For sure.
We're repeating the same thing.
Well, plus it was a combination, right? It wasn't just a Palisades fire. What happened?
Yes.
Okay, so let me expand on that for just a minute.
Yeah.
And as I prepared for this time with you, I'm like, hey, Cory, we talk so much more personal than we do business, but there's sometimes
it's important right now.
It's important right now, and there's not a lot of experts in the field. There's a lot of opinions, right? Because people don't know, do I believe what the big three are telling us that's on the media, or do I just want to get like my data points from the people, boots on the ground? If I understand correctly, there was a recent change from the Deputy Insurance Commissioner about allowing the big carriers to now increase that, right? Because before they capped them to a certain degree, but now they're going to allow them to because they really need them to continue to write insurance, which kind of was this problem that started a couple of years ago. You limited them, so they stopped writing policies or slowed down.
Yep.
And then people had to go to the California Fair Plan. Am I correct that there was kind of an announcement or change from the Deputy Commissioner, and how will that now impact, call it a homeowner? And then I want to dig into the Homeowners Association.
Yeah, so from that perspective, yes, what we talked about with only being able to raise the rates a certain percentage. So during COVID, they capped it and said for the first 2 years, these insurance carriers can apply for a rate increase, much like the utility companies do.
Sure.
So they put that in. If it's above 7%, it goes to additional audit and thing. It's too much red tape. They have to give all this information so they don't do it.
Got it.
Because it's too intrusive.
Sure.
Right. You have a lot of watchdog groups that want to have all this information and see everything and critique how much money you're making and all those things. So they do that. So yes, the carriers have said, if you want us to stay in the market, then you need to let us raise rates so they can do it. So they're going to make some exceptions. Those haven't gone through yet completely. They're also looking, which is kind of interesting because the California Fair Plan is a plan of last resort, but now they're expanding it.
Okay.
So, right, you have a government agency that's regulating a group or a function of the economy.
Yeah.
But they're not actually doing it because the carriers are the ones that are actually carrying.
They're really the responsible party to a certain degree, kind of under this blanket of the state.
And they just announced another thing that you can't cancel a policy for another year. So again, company not making money, told that they can't stop providing that service for another year and continuing to lose money. So wherever you are on the spectrum of, hey, these insurance companies are making a ton of money, this and that. I mean, there's a lot of money that's being pushed around. But at the end of the day, for a typical homeowner, right, things are only going to continue to get more challenging.
Right.
If we're staring at $250 billion in losses, where is that going to come from?
Right.
It's not going to take any air out of the room. And really the thing that we were hoping would happen before this happened is you let those carriers raise their rates. They come back in the market, and now there's some competition.
Yeah.
And what does competition do? Competition should hopefully
drive the price
down.
Yeah.
If you're in that non-admitted or that 500 credit score, you got no option.
Yeah.
And that's really what it is. So you're trying to push them back into the submitted market because traditionally it was 15% that were in the non-admitted. Now it's going,
what is it?
50 plus.
Wow. Because I know I'm dealing with 30 clients a month. Either they have insurance or they're trying to get insurance. And
that used to be an afterthought, right?
It did. I mean, we're now forcing clients to get insurance
first
within the first 3 days of a transaction, or else, and we've had clients actually cancel contracts. The home I just sold recently that I had for 25 years, it went from $3,000 forever, $3,500 a year, to $6,000 to $8,000 to $12,000.
Yeah.
And then someone who bought my home had a combined California Fair Plan. For those who don't know the California Fair Plan, it's a state insurance fund. It only covers you for fire. You still have to then go get an additional policy for inside contents. What's it called?
A wrap policy.
Wrap policy that, covers things like water damage or things like that. The person who bought the home that I sold was paying like over $20,000 a year. There's some people who've closed escrows locally here in Coto de Casa. We're talking $25,000, $30,000 policies. And so it's interesting. We haven't seen a total slowdown of buyers because of insurance. We've watched them become more cautious. That's for sure. So, go ahead.
No, it used to be right. Do you have a proof of funds? Right? Are you pre-approved?
Yeah.
Now you have to have that.
Yeah.
But now the next thing is
insurance.
What about the insurance?
It's part of the transaction now. So you have real estate agents with people buying residential, and then we're going to get to HOAs in a second.
Yeah, no, it all ties together.
It does, but the HOA is your specialty, and that I think there's a bigger problem coming, as you know, that we've talked about that I want to talk about. But one last thing. Great real estate agents today are making it part of the contract.
Yes.
You have to get your insurance in the beginning because you don't want to go 10, 12 days in a contract and all of a sudden the person's like, I got an insurance quote for $37,000. I can't afford that. And so really good real estate agents are getting in front of that.
And we've been putting together some educational stuff on that because it's a new education that those realtors need to know because it changes the conversation of where you're starting. And we see it as we work with a number of different professionals who say, send us 2 different properties you're considering. There might be such a delta in the insurance that could impact the home buyer's decision
for sure.
Of which, if it's in Coto de Casa and it's right up against fire and it's going to be $50,000, or you can go somewhere else and it's $20,000.
Right,
$30,000 a month additional carrying cost or a year is going to weigh.
It's a big difference.
Alter your decision. So now, insurance is coming into play, and like you said, it needs to happen earlier instead of we're just about to close. Go find some insurance real quick, and then we'll close this loan.
Yeah.
So it's changed the order of operation.
Well, one quick final note on that, and I do this a lot. Here's my final note, and then we're going to move on to HOAs. What a lot of people don't realize is when you bind that new policy, a lot of the non-admitted carriers, call it your lower credit score, you got to pay up front. And if you cancel in the first, I think it's 90 days or so, that portion of the premium is not refunded.
It's called earned premium. It's kind of like in a retail, like a restocking fee.
Yeah.
Right? You can buy this, but when you bring it back, we're going to charge you a
restocking fee.
So yes.
So I had a client who didn't have a choice because they didn't do their job. They ended up taking really bad insurance. Mm-hmm. They found better insurance a month later. They were eating that, call it 90 days of premium. Okay. Let's talk about homeowners associations. Let me do a quick preface, okay? Because I do a lot of condos throughout the state. And most of our now 4.2 listeners are not going to understand why there's such a challenge with insurance for homeowners associations, and then how that's going to impact people who want to sell or refinance or anyone buying. Give us a deep dive, take a couple minutes, tell us the challenge now with homeowners associations, why that's such a passion project of yours, and how we can try and make it better, right? We can't fix it tomorrow, but all we can do is try and you take the cards that you're dealt in the morning. You're like, I got to make the best 3 of a kind or best full house I can. What's the challenge with homeowners associations right now? And what can we do to try and at least make it better? Like what's on the horizon?
No, understood. Yeah. I think there's 2 sides of it. There's the buyer and the seller, right? If you're in the position, it's a little different scenario than if you're not. So if you're not, right, look at the insurance, understand that. We look at those CC&Rs and the governing documents and a budget, and you're like, oh, yeah, it's fine. Dig into those, see how much money they have. And really, those financials are going to tell a story of the health. Now,
which no one reads those. I know you know that.
But it talks about the health of the HOA, right?
Yeah.
So really, the biggest thing with the HOA is the total insurable value. What is the value of the overall property? So let's take a property in South Orange County. Got 100 and something units. It's $40 million to repair or to replace.
Okay, real quick, $40 million. And I know there's questions about this. $40 million. Is that what they thought the building was going to cost to replace 7 years ago? Is it based on a little more recent data with the increase of labor and materials? What is that?
It should be. Most of them use different rating systems to determine a cost per square foot to rebuild, kind of much like you do when you're determining how much the insurance is for a primary resident.
Sure.
Same thing. What they're finding out is, right, it's a deficit when you actually go try to rebuild it, right? Yeah. Because it's fine if it's just one, right? But the palace fires, right, you're competing with all this other stuff. Everything is at a premium,
right?
So that's the thing. But getting back to that total insurable value, that's the challenge, right? Is one carrier willing to take on that much risk?
Is one carrier going to take on the $40 million, right? Yes. Especially in an area that's even remotely got an opportunity that there's going to be a fire or disaster or something like that.
Correct.
So that's part of the challenge, right?
And then the FHA is the other issue.
Yeah.
Right.
We're going to get to that in a second. I know one of the challenges is this. Let's say that property in South Orange County, replacement cost is whatever, $40 million for the entire project. Well, a couple of things have happened, right, from what we've seen. The cost of the premium for that $40 million is up exponentially, number one. And to focus on that for a second, if you have $40 million in insurance that you need, and it used to be 50 grand, I'm just giving an arbitrary number, and now it's 100 grand.
Or 400. It's gone 5X.
Is that the delta? 5X?
We always
4X?
say, if you get, what we see is if you get canceled by that admitted carrier, you're looking at a 2 to 5X increase.
Okay, so let's talk about that for a second, because here's what a lot of people don't realize. You own a condominium, you're part of a homeowners association, your $50,000 premium just went to, let's say, $250,000. Yeah. The majority of HOAs do not have a free $200,000 a year floating around. Condo owners are going to get reassessed, right? And the homeowners association dues are not going to go up to mitigate that increase.
Which makes it less desirable to sell.
Less desirable, right?
Compared to, what else is available in the market.
Okay, so let's talk about the other challenge that I know, because you and I have talked about this deeply, and now I think we may have 5 listeners, and I want all 5 to get this. So that's only challenge 1. So these associations are trying to get the insurance to replace the building. The homeowners is going up exponentially, right? And so now you've impacted the people that currently own. Let's put the people who want to buy just to the side for a second. Let's just talk about the people that currently own. That's one challenge. Here's a second challenge. Can you get the 40 million?
Sometimes.
Right?
Sometimes. And to your point, there's sometimes you can get the 40 million, but that might cost you $1 million.
Right.
So what do? Do you bankrupt the HOA or do you carry less insurance?
And is option B is what they're doing? Well, not all of them. That's the logical answer, right? Because the association's like, our hands are tied. We can't get 40 million. We can get 20 million. This is hypothetically, right? So let's say the association's like, we can't get 40. We can afford 20, whether there's an increase in assessment or not. Put that to the side for a second. Now the association's short $20 million, right? You and I have talked about financing becomes a problem. Right? So you've got these associations that want to help someone sell the condo if they want to and want to bring in the new buyer, but that new buyer can't get financing.
And exactly. And what that is, right, you know it better than me, is the FHA, right? And we've seen somewhere, I've read different things, 75 to 85% of loans in HOAs, because they're usually, a cheaper price.
Sure.
First-time home buyers.
Sure.
They're taking advantage of that FHA opportunity.
Yeah.
Right. And there's 2 requirements for FHA. And you know them better than I do, but we hear it all the time, is that they want it insured 100% to the value, right? So that 40 million that's only insured for 20 million, strike 1.
Right.
The other issues you have is that 5% deductible max. And a lot of HOA policies that most homeowners don't understand it, but there's higher deductibles. The HOA is not meant to take care of everything.
Yeah.
They're meant to take care of the structure when there's something catastrophic that happens.
Sure.
And because the prices have been going up so much, one of the levers that we say you can move is you can move your deductible. Like your auto insurance. If you go from a $100 deductible to a $1,000 deductible, definition of insurance, transfer of risk. You're transferring less risk to the insurance company, so you're going to pay a lower rate.
Yeah.
So in order for these HOAs to get that higher limit coverage, they have to accept a higher deductible. But in accepting that higher deductible, that's strike two
for
against
the loan.
FHA.
That's right.
So we say, if you can't buy or you can't sell, how much is that property worth?
Yeah.
And it's becoming an increasing problem in the higher fire risk areas.
Of course. And now I would imagine, I'm experiencing this a little bit, but you're experiencing more. I mean, I know you have thousands, if not tens of thousands of doors that you insure. What are the associations trying to do right now in the sense of, I mean, they just can't help a lot for the people that are there. And for those of you listening, when you're trying to buy a home in a condominium project, you have to go get a loan. There are some certain guidelines that come into place that Cory was just mentioning about. The insurance has to cover replacement, and you can only have a certain deductible. Aren't some of the associations trying to increase that deductible, which then negates the opportunity to get a loan? So it kind of becomes this vicious cycle of you can't really solve for it. And then that creates a challenge of it changes the buyer pool, right? Now it changes supply and demand. The demand's not very high.
And it's got to be a
because
cash
no one
buyer.
can finance, and it becomes a cash buyer, which in theory, then someone's paying less for that property. Is that cycle kind of accurate for you?
Yeah, and it comes into a catch-22, right?
Yeah.
Because in order to get the full insurance, some of that risk profile has to go down. They didn't move, they didn't do anything wrong, but the risk profile is increased.
Yeah.
CAL FIRE, these different agencies map, the Willis score, all these other things, they determine the risk profile, and then the insurance bases their rate off of that.
Yeah.
So they're not willing to take on that risk. And what we've seen is with that 20 million, you might have 4 carriers because nobody wants to take on that full 20 million. They're like,
right.
I'll take the first because that's the biggest. And then it's called, in a sense, reinsurance. So it's kind of like when you make a bet with a friend and you split it 50-50, the most you're going to lose is that 50%.
Yeah.
You're not going to get all the windfall, but you're also not getting all the loss.
Do you do that, by the way, on Raider games? So you try and downsize your risk?
I usually take the over on the Raiders game because that's about the only safe bet.
Yeah, right.
And let's not get started about KC, okay? Because
will you be watching the game Sunday?
I will be watching.
Just because the love of the game,
yes,
right?
Yes.
But who do you think wins on Sunday?
I think the referees win.
Oh, come on. You cannot be that conspiracy
No, I'm
theorist.
not. But I think Taylor Swift will win. Yes.
Okay.
It's good for football.
It is good for
football. It's good for football. They have so many more viewership, and
they do.
At the end of the day, it's
about money.
It's a marketing machine. So anyhow,
I want to wrap up on insurance,
Yeah.
and then I want to talk about a couple fun things.
Yeah.
Are some of the associations in your experience right now just saying, listen, that there's nothing we can do. We're going to be underinsured. And really, to a certain degree, until something changes, they just have to hope and pray that it doesn't happen. Number one. Number two, if you can wrap this up, can the association go to the members and say, listen, we don't have a choice. You're going to now have a 10% deductible. Regardless of someone who can't get financing, that's almost the second most important part. Can the association say, this is the insurance, here's how much it is, your homeowners association dues are going up $100 a month, and your deductible is now 10%. Within as long as it's in the bylaws and the agreement, can they force the homeowners to have an increased deductible regardless of whether someone can get financed or not?
Yeah. So each HOA CC&Rs, the governing documents are a little bit different, but just kind of a general rule to go. The HOA can raise their HOA dues 20% a year without going out to membership for approval.
Okay.
So that's the first thing they do.
Sure.
And we experience a lot of boards that go, we haven't raised our rates in 10 years, and they're proud of it.
Yeah.
So nothing goes up in price, to landscaping, to this, to this. So if they haven't been raising their funds and been keeping that reserve fund for all of those other items that need to be a roof, right? That's 30 years.
Right.
You're collecting part of your
concrete, streets,
all that
lights,
stuff is for a later date.
Yeah.
The problem with the insurance is it goes up to $250,000. You pay $250,000. for 1 year of insurance.
Right.
You don't get a new roof. You don't get new windows.
Right.
And the next year, especially after this happened, it's going to be $250,000 again.
What do we just best guess? What do we, I'm going to consider us in a little bit of a chaotic mess right now. And it's kind of like, Trump's announcing tariffs. We'll have some pain.
Yeah.
I believe the tariffs will help us get better, but you have short-term pain to get to a long-term. Best guess, how much long of chaotic turmoil for insurance for homeowners associations and homeowners? 12 months, 24 months, 36 months? Just curious what your assessment is of like what your guess would be.
I think it really, there's a couple of factors that have to move. And I think it is some of the governance that's taking place that they have a different view.
Sure.
If that view or if that mindset stays in place, it's going to continue on longer, multiple years. If
they don't make some improvements.
Yeah. What I'm hoping is that this gets so catastrophic and this gets so necessary to make dramatic change that they do that, that they let them raise their rates a much higher rate. It's never going down, right? Gas is never going to be $2 a gallon.
I tell people that all the time.
We have a new reset, and that insurance needs to get up to that point.
Yeah.
As well as realize that now the models that they're using, it's much more to replace this stuff. You don't just go, oh, it was $160 last year, so we'll put another $10 on it. So now it's $170 a square foot. It's not that simple of an equation.
Impossible.
Yeah.
And I'm not going to defend the big insurance companies, but there are times you have to look at both sides of the fence. I don't care who you are. I'm not in the insurance business, so it's easy for me to play armchair quarterback and say, you're making all this money. No one really knows. So do I think that there's been some times it could have been a little more favorable to consumer? Of course. But you also do have to put yourself in their position. And one of the things I appreciate where the big insurance companies are, like I've got two friends that are general contractors, build custom homes. They're just building a home. They're not insuring 50,000 homes. They can't even keep up with the supply chain cost changes and labor cost changes. Like some of them are putting into contracts like time and labor and materials where the consumer is just paying directly for the cost of materials. So if it goes up $8 or down $8, they're going to get the cost of it. But it's impossible for general contractors on one home to gauge that. I don't think people realize the difficulty. Let's face it. There's someone with an Excel spreadsheet in a small closet somewhere who understands this.
I hope it's more than an Excel spreadsheet.
For insurance,
I hope there's a few more actuaries that know this. But yeah, to your point, I mean, they're calculating a risk. That they're going to charge a rate for the next 365 days.
Right.
So
they got to hedge that. They got to hedge the cost of material changes, labor changes, all that stuff.
So we're an insurance broker, so we're going to all of those carriers, and sometimes right, it's the same thing with you, right? You're not holding the loan. You're the one that's facilitating to the right solution. Sure. And so there's those two different things. And the carrier is the one that's taking on the risk. So, right, they're calculating the risk. And if a big claim happens, they need to pay for it. Yeah. So that's their thing. And a lot of times, a lot of HOAs, they misunderstand. Well, we're up to code, fire code, this, that, and the other. Like these carriers are not taking direction from what local governments have said is feasible.
Right.
They're determining their own risk level.
They have to.
And then assessing a rate based off of that. So, in the short term, it's going to continue to be painful.
Yeah.
Although tragic, I think this recent fire is going to shed some light on it. We're very much the same here in Orange County.
Yeah. Oh, for sure.
Rancho Santa Margarita down to Newport Beach. If you look at it, if there's 90-mile-an-hour winds, which they could be, get out of the way.
Yeah, yeah.
And if that happens, right, history is already starting to repeat itself. Yeah. So if we don't make some changes here, we're just going to be doomed to repeat the same. We're just waiting for that next big storm. Yeah. And the way that they're attacking fires, I mean, the firefighters and everyone are amazing. Yeah. But it's such a monumental task. Yeah. And right, if we're using airplanes and helicopters to try to think and to fight the fires, but then when the wind is too much, we can't do it. Right. What's the solution? So I don't know what the solution is. We've obviously developed in a lot of areas that make it risky to have a house there. Because nature will take its course, right? And it has.
And the next time you and I talk, we're going to get a little bit political because I know we share a similar view. I'm not saying our view is right, but we both know there's been. You don't even have to believe all of the rhetoric. If you believe a percentage of the rhetoric, our state has done some things. that has prevented. We don't know the level of success we could have had in fighting some of those fires. It's impossible to gauge, so I don't believe the rhetoric that's online. But we've definitely made some budgetary cuts in our state in one of the probably the largest disaster category that our state experiences. By the way, every year we don't have an earthquake every year.
Yeah,
right. We don't have. Some parts of the state have some minor to medium-sized floods every year, but we have fires every single year, and that's a different conversation. So one last thing on business, and then we're going to do a couple personal and then wrap up. If people are a condo owner or if they're on a board of an association and they're just confused about the rhetoric, you could look at their policy form, just give them an assessment. Hey, I think you're actually good. Hey, I don't think you could do anything better. Hey, you should probably look at this, right? I mean, that's
what we've been doing more so right now because of the fires. There's a lot of carriers that are in a moratorium, which means they're not writing new business.
Yeah.
So we can't write new business in a lot of these areas. So yes, 90% of what we're doing is giving a validation.
Yeah.
Yes, you do have the right coverage. You know, because everyone's going to be, are we covered for fire? Right. We've had hundreds of clients that reach out and say, are we covered?
Are we covered?
Right.
Yeah.
So, same thing when an earthquake happens, people go, hey, how much is earthquake insurance?
Yeah.
So from that perspective, so yes, we're happy to do that. A copy of the certificate. We'll make some recommendations. Is it a deductible? Is it maybe looking at a different carrier? The challenge is, again, there's not a lot of carriers that are willing to write this stuff.
Sure.
Even in that non-admitted market, once you get over that 50 million mark, which is like now a 150 unit condo complex, and there's 55,000 HOAs in California.
Yeah.
So there's a lot more people in that kind of red zone, I would call it.
Sure.
So there is stuff to look at, but making sure that the policy is adequate.
Yeah.
The other big thing is looking at the CC&Rs, so those governing documents. When they were first written, they were more ambiguous because insurance was cheap.
Yeah.
Now it might
totally different. Most of them probably haven't been updated.
Right. Yeah. As best as possible, or there's a lot of generic terms that are used. So a lot of HOAs are redefining those to give the board more control to be able to find something that's affordable.
Yeah.
Calculating the risk.
Sure.
And then determining how we go forward, right? Do we want to raise our dues from $400 to $2,000 and have full coverage insurance?
Yeah.
Or are we going to go with half of that and they'll only go up $600?
And then you just run the risk of buyer pool and things like that.
We have an HOA that was in San Diego that was really close to those fires, right? They have a wildfire exclusion, which they couldn't get insurance at all. And they only had $2 million in wildfire. What that means, if the whole $40 million property burns down, insurance company's going to write you a check for $2 million and say, good luck.
Wow.
So that's the
risk.
The severity that's going to keep going. So for your buyers, like beware of that. Look at that financials. Help your client look at those saying, hey, let's look at the financial health. If they did get hit with, I always say a 5X, we talk to our property management professionals. If you're managing a project and you see a budget line item and it won't be okay if it goes up 5X, you might want to focus on that.
You're going to have a challenge there.
Right. Because if it hasn't happened, it's going to continue to happen.
Yeah.
So.
Not because I've been in the mortgage business for 32 years. I'm interested. I'm interested in insurance. I'm interested in commercial insurance, general contractors, general liability, the crazy workers. I'm just always fascinated by insurance. I know there's two sides to the story. It's crazy to me, like how detailed you are about the successes, the failures, the pros and the cons and the risks for what people have to look out for, which is why I love our relationship, because you and I can go have sushi, all you can eat, which we love doing.
It's been too long. We need to get that back on the books.
Yeah. But
this is not sushi.
No, but just being able to talk about that is great. I'm going to wrap up with one more comment, really. One of the questions I asked you is last day on earth, favorite meal. And it's just an affirmation of why we are so connected as friends, because you're like, big tomahawk steak. I'm a filet guy, but I love tomahawk. And when you said, of course, 2 old fashions, it's interesting. I just started drinking old fashions. I'm 57 as we're filming this, like a year and a half ago. I was just never that flavor of a after dinner drink, if you will. And I'm hooked on them now. I can't, I want to try one everywhere I go. And as I'm reading this is what will be my last meal, it really could have been from Chris Chudikoff instead of Cory Neubauer. And it was just such a great reminder of why I just think alike on so many topics with you about that, because that'd be a great final meal, by the way.
For sure. And you know what, we've talked a lot about me, but the relationship that you and I have has grown over the years.
For sure.
And right, we're confidants. Or I have another relationship with a friend, and we used to call it a mentor-mentee, but now it's a mentor to mentor.
Yeah.
Right. You have areas of expertise. I have areas of expertise, but we all have enough knowledge to be able to figure things out.
For sure.
And if we don't, we know what we don't know, and we're open to asking for help.
Yeah.
Or I'm not sure if you said it, but I'm in my head you've said it. I don't give a referral. I'll make an introduction.
Yeah, that's right.
Because it's your job to go sell yourself, to go get the service that you need.
That's right.
But if you know people, you can get so much further. And I think you have an amazing bullpen of resources.
Very fortunate. Thank you.
And I do the same thing. And it makes you feel like a ninja. And it's so great when you can help somebody that you don't know anything about, but you're like, I got the guy.
Yeah.
Like get to that guy in the world and talk to them. And they're so thankful. And you're like, I didn't do anything.
Yeah.
This person did it, but that's the joy. And I think that's what ties us together is we have that joy.
For sure.
For just like, let me see what I can do.
But you got to remember, but we're not doing that with everybody. Not everyone is like Cory Neubauer for me, right? And I have some other Cory Neubauers in my life, and and you and I've shared a lot of referrals back and forth. But when I refer you to somebody because of my relationship with them, I don't want to say they don't ask.
Yeah.
They just know if I'm willing to say, you need to connect with Cory, that they will. I'm going to tell everyone goodbye in a second. Looking at that other camera, if someone wants to connect with you, what's the best way for them to reach out to you before we start plastering you all over social media? Gotcha.
No, I appreciate it. Well, Chris, thank you again for having us. Next Tier Insurance Services, easiest way is our website. The shortest one is nxtins.com. You can reach us there. We have all our information there. We're happy to help. We're on socials everywhere. We do a lot of education, and we really believe in doing the right thing. It's integrity, doing the right thing even when no one's looking. Yeah. And that's what we're going to do. We're going to walk alongside you, and we're going to help you figure this out. Of course, we want to grow our business. We all want to grow our business.
Sure.
But we want to do the right thing. And in helping people and creating that network, it all comes back. Yeah. And I think that's what you and I have of you see that from the charity work and stuff that you do and the vibrant thing. It brings life, right? We're blessed to have all these opportunities. And at the end of the day, let's share that. And it's not just financial, it's opening pathways. Yeah. And I think that's so important. And that's what brings me joy besides, which you didn't let me talk about my wife. My amazing wife that puts up with me, and my
Tina will curse me later for that one.
Tina Neubauer. She is
because I talked about kids and Raiders and
she's the brains behind all this stuff. She's been in the industry for even longer. Yeah, and I don't hold a candlelight to her knowledge. Yeah, she is like an actuary. She knows it all. And then my beautiful children, Luke, which is 9, and my daughter Ava. So you talked about, and I'm going to gloat. You talked about taking time. So my son has some mental challenges, some issues. He's amazing, but he started fencing recently. Nice. And he's just started doing private lessons.
Good for him.
So we're picking him up at 2:30. Tuesdays our day. We're dialed in.
Love that.
Nothing else is going to take the place of that.
Yeah, and of course. And that's I would expect nothing less.
That's the back and forth that you want to work hard and provide, but you also need to be there because man, life happens quickly. Your kids are grown now. I turn around and look and I'm like, they're 9 and 7?
Yeah.
Like, when did that happen?
I got a 7-year-old granddaughter.
Yes.
It's crazy. I'm grateful most importantly for our friendship. If you've really listened and spent any time here, Cory is an expert. He is not like knowledgeable. He's an expert in his field, and it would behoove you to connect with him. If you have any questions, the best thing about Cory is not what he does for a living, is he leads with a servant's heart. He never talks about monetizing anything. His focus is truly a servant heart, helping people. And if the transaction comes, it comes. It's just not who he is. So it would behoove you to connect with him. Thanks for listening, Cory. Thanks for spending some time with me in the hot seat. Can't wait to have sushi again soon.
Yes, and hopefully we'll be back again soon with maybe a couple thousand viewers.
Yeah.
Okay.
We'll look forward to it then. Thanks. Right. Thanks, everybody.